In this presentation, we will take a look at the audit process related to cash and cash equivalents. Cash and cash equivalent. First, we'll take a look at some definitions. We need to know what cash is and then what cash equivalents are. So cash is currency on hand and cash in the bank account. So obviously, the most common form of cash we would think would be in the checking account for a type of business, but of course, any cash that would be on hand, also a form of cash that would be included in the cash line item on the general ledger and in the balance sheet. Certificate of deposits, time deposits, and savings accounts would all be included within cash. Cash equivalents are generally combined with cash in the financial statements. Note then that when we're considering the books, we're typically thinking that a company on a trial balance would probably have a separate account for the different types of cash accounts and the different types of cash equivalent accounts. When we then go to the financial statements on the balance sheet, we would expect those to be combined into possibly just one line item called cash and cash equivalents on the balance sheet. So when we test these types of items, we would expect possibly most likely on the trial balance that we would be considering the different types of accounts, such as a checking account, a savings account, possibly a payroll account for cash, then any cash equivalent types of accounts. When we go to the balance sheet itself, then these often being combined together for one line item on the balance sheet. Definition of cash equivalents. Short-term, highly liquid investments that are readily convertible to cash or near their maturity, that there is little risk of change in their value. So I'm going to read through that one more time because the cash equivalents, of course, are going to be a little bit more difficult for us to understand. We pretty much know what cash is with regards to the checking account, cash on hand. The cash equivalents are the ones that could be a little bit more tricky. So we have short-term, highly liquid investments. So highly liquid means they're going to be convertible to cash very readily. We don't have the restrictions or many restrictions on the investments at all, and therefore they will be highly liquid, that are readily convertible to cash, so they can be converted to cash very easily, or so near maturity that there's little risk of change in their value. So if they're really close to maturity and there's little risk that there's going to be change in value, then possibly cash equivalents. Examples include treasury bills and money market funds. Now, when we think about cash, we want to think about all the processes that are related to cash. And notice cash is going to be different than most any other account, of course, because it's going to be part of many different processes. So unlike some of the processes we've talked about before, where we can basically think about the accounts that are going to be mainly used specifically in that process, cash will be involved in many different processes, and that makes it a unique account. It also makes it an account that has its own specific kind of challenges when we go through the testing process of it. It also makes it an account that we do test for as we go through pretty much every other process. As we think about testing every other process and every other account, pretty much every process will typically have cash involved in it somewhere. In almost every account that we look at could have a cash component to it as well. Therefore, as we go through the testing process of all the other processes, we should have some testing within the cash account. However, again, note that we can't just see, like, for example, all the deposits in cash and assume that those are all going to be basically revenue. Although we could think a large portion we would hope would be revenue for the deposits. The money going out, even more complex, because the money going out could be for various different types of things like purchasing assets or different types of expenses. So we can't just basically test one process. In other words, in order to test cash, we have to take some other kind of approach. If we think about the things that will be involved with cash, we have things such as revenue involved with cash. The sale of property, plant, and equipment could involve cash. Insurance, issuance of long-term debt for cash. These are cash increases. And we could have the issuance of capital stock. These are all things that could increase cash. So we'd have to look into those types of things. And again, note as we think about the accounts receivable or revenue cycle, we test cash to some degree. When we think about the sales of property, plant, and equipment, or test property, plant, and equipment, we may test cash to some degree. When we have the issuance of long-term debt, when we test, in other words, the equity section, we test cash to some degree. But no one point of these things can test cash completely. And then on the cash going outside of things, we have purchases involved there. Payroll is going to be involved as cash is decreased. We have the pay the long-term debt, cash goes down. pay dividends. Purchases could be for inventory, could be for property, plant, and equipment. Again, a lot of different things, of course, that's going to be involved in the cash process. And also, as we go through these things, as we test these things, as we test the purchases process, for example, accounts like accounts payable, as we test the payroll process, we are in some degree or to some degree testing for cash as well. Now we'll consider the controls effect on cash. Reliability of controls over cash impacts the nature and extent of the auditor's tests of details. So we would expect there to be some controls over cash, fairly strong controls over cash, given the nature of cash being somewhat of an inherent risk factor and due to its liquid nature, and also something that's going to be involved in many different processes. So we should have the controls over the cash receipts. And notice we've discussed some of those controls as we've thought about the processes that are involved typically for the sales process and other types of cash receipts processes. And then controls over cash disbursements. And we've discussed some of those controls as we've thought about the purchasing process, for example. And then, of course, the monthly bank reconciliations. This is something that has to be done. And this is something that should be in a control in a large company or a small company. We've talked about some types of controls where we said a large company would want to do this, but a small company may not have the personnel, oftentimes is the limiting factor. The bank reconciliations is something that should be done any level of type of organization we have. It's really a huge type of control over the cash, and if we can get some controls over cash with a bank reconciliation, we could feel a lot better about a lot of the other processes we have because, of course, cash is involved in these processes to some degree. So any size of the company, want to make it clear, bank reconciliation, something that should be done. Now we're going to take a look at the substantive analytical procedures related to cash. So we're considering those analytical procedures. Remember, these are the types of procedures that I would imagine we're an auditor. We're cozy in our own auditor's office. We're not at the client's office. We're doing analytical procedures, which are kind of like the comparison ratio analysis type of procedures. The auditor's use of substantive analytical procedures for cash is generally limited to comparison with the prior year's cash balance and comparison with the budgeted amounts. Now, note this is a lot less types of analytical procedures than we might do elsewhere, but we're limited to these types of things because of the nature of cash, because it's involved in so many other types of processes. We can't do as many type of ratio analysis. We can't do analysis of comparing cash, say, to sales or cash to accounts receivable, because cash is involved in so many different processes that it's difficult for us to make that analytical procedure type of comparison. This limited substantive analytical procedure is offset by tests of controls and or substantive tests by transactions for cash receipts and disbursements. So we may do other tests of controls, other tests of transactions, we will, in order to account for the fact that we cannot do as much of the substantive analytical type of procedures. Tests of the entity's bank reconciliation. Obviously, the bank reconciliation is going to be a huge component when we think about the testing for cash. Tests of transactions for cash receipts. We have our assertions and then the testing. So occurrence, the assertion of occurrence. Vouch a sample of the entries in the cash receipts journal. So the cash receipts journal, vouch them to the remittance advices, daily deposit slips, and bank statement. Now remember, occurrence is going to be the end product. So we're kind of thinking we got the financial statement put together and we're going back to the source document to see that the thing actually occurred that's going to be on the statement. This is going to be important for cash because we would think when considering cash receipts that it would be more likely that something would be reported to look better to have a receipt that didn't actually occur. So in order to do this, we're going to vouch a sample of the entries from the cash receipts journal, basically the end documentation, and go back to the source documentation to remittance advices, daily deposit slips, and the bank statement. Then we have the completeness, which would go basically the other way. Now we're looking for items that could have happened that didn't get reported in the end results. On the financial statements, we would think something like a cash receipt not being included when it should have with regards to completeness. Trace a samples of remittance advices to the cash receipts journal and deposit slips. Now, next we have the assertion of authorization. Examine the signature on the deposit slip and the check endorsement for correct authorization for a sample of days. Authorization, by the way, is another type of control that really should be involved no matter what size of organization we have. In other words, even if we're a very small type of organization, you still want to have basically the authorization process of some kind as an internal control with regards to signing the checks and finalizing payments. Tests of transactions for cash receipts, accuracy, the assertion of accuracy. For a sample of daily deposits, foot the remittance advices and entries on the deposit slip, footing meaning to add them up, match them to the cash receipts journal and bank statement. For a sample of weeks, foot or add up the cash receipts journal and match postings to the general ledger. And then we have the assertion of the cutoff. So remember, that's going to be the year end or the end of the time period, typically 12/31 if it's a calendar year end being the cutoff time period. Compare dates for recording a sample of cash receipts transactions in the cash receipts journal with those found on the bank statement. Look for significant delays. So notice what we have here. The cash receipts journal, we're saying, is our book, and then we're considering the bank statement. So we're going to compare the dates. The dates aren't going to be exact because, of course, when we record the cash receipts in our book, we record them when we receive them. When they get reported into the bank, they're going to get delayed to when the bank finally gets the information. They're going to lag. They don't have the information until a later time period that we have the information. But we want to look for significant lags because if there's a significant lag, you would think something funny is happening, especially if we're talking about deposits. These are deposits, should only take like 3 days possibly for a deposit to go through. So if there's a significant lag in that process, then we would suspect something funny possibly is happening. If that lag is happening close to the cutoff date, 12/31, especially if it's going to be a lag that went over the cutoff date, something's being reported that you would think if it wasn't for the lag, it would be reported in a different time period, then we might be concerned with those types of transactions. We want to look into those. Observe cash on hand for the last day of the year. So we want to consider and think about what is the cash on hand. If they have something reported for cash on hand, then we can actually go and observe the cash on hand, especially if it is significant or material. Trace deposits to cash receipts journal and cut off bank statements. And also note when you observe the cash on hand, you might think, well, that doesn't seem significant. It might not be material, but if you're talking about the cash that's in the company on hand instead of in the bank account. But notice that if you're talking about some types of companies, like if you're auditing a casino or something like that, then of course the cash on hand, the cash that's there local, could be quite significant. I've actually had instructors that audited casinos, and they had to basically shut down the entire casino for a little while so they can go and count all the cash that was on hand at a casino. Then we have the assertion of classification. We're going to examine a sample of remittance advices for correct account classification. So we'll examine the remittance advice and see if we have the correct classification related to it. Now we're going to consider tests of transactions for cash disbursements. So now we're considering same assertions, going through the cash disbursements as opposed to receipts. Assertion of occurrence. Vouch a sample of entries from the cash disbursements journal to the canceled check. Voucher packet and bank statement. So occurrence, remember, means we're thinking about the end product, and then we're going to go back to the source document to see that it actually occurred and therefore should be on the end product. So once again, we vouch a sample of entries from the cash disbursement journal, the end product in essence, to the canceled checks, and voucher packet and bank statement. Now, note, you might be thinking, well, the cash disbursement journal, you may not really know what that is. And if you go to the bookkeepers, they may not exactly know what that is as well. What we're really looking for is just basically kind of like the GL for cash, but we only need the disbursements. So if it was a handwritten document, if we were doing the whole accounting system by hand, we might record things in a cash disbursement journal to make things easier. And so I think these names of a cash disbursement journal are basically carried over from a time period when we didn't have as computerized a system, and now we still use them. So in a computerized system, the report might be called something else. We're basically looking for cash disbursements here, and so that we can see the cash disbursement. So we want a cash disbursement report, cash disbursement journal that we can then use to take a look at the sample of the entries. And then we're going to have the completeness, the assertion of completeness. Trace a sample of canceled checks to the cash disbursement journal. So completeness, remember, going the other way. Now we're considering is the end result complete? And therefore we got to go to the source document and then check that information to make sure that it's been included in the end product. And then we have the authorization, assertion of authorization. Examine a sample of canceled checks for properly authorized signature and endorsement. Then we have the assertion of accuracy. For a sample of voucher packets, match amounts in purchase order, receiving report, invoice, canceled check, and disbursement journal. For a sample of weeks, foot, or add up the cash disbursement journal and match postings to the general ledger. Next, we have the assertion of the cutoff. That's the year end that we usually consider if it's going to be a 12/31 year end or a calendar year end, the cutoff being 12/31. Compare the dates on the sample checks with the dates the checks cleared the bank. So now we're considering the other side of things. We want the dates on the sample checks to when they cleared the bank. Notice that this lag, we're looking for the lags in that time period. There's always going to be a lag. It should be more significant. We won't be as surprised if it's something longer than 3 days with regards to the cash disbursements, because you would think that it would take more than 3 days for a check, if we wrote something like a check possibly, or a disbursement, for it to go through the mail and then get to the other person and then go to the bank. So we would expect a longer lag between when we wrote the check, when we know about the transaction, when we record it in our books, to when it cleared the bank, which doesn't happen until the bank knows about the transaction, which doesn't happen until the check is sent, received somewhere else, went to the other person's bank, and then our bank was basically contacted with it. So we would basically expect a longer lag, but we want to think about unusual type of lag, especially those that may go over the cutoff period and be reported in a different cutoff period due to that lag, and then consider those items. Record the last check issued on the last day of the year. So we want to consider that last check that's going to be issued. Take a look at it. Trace last check issued to the cash disbursement journal. So we're going to take that last check that was issued and traced it back as a form of basically the cutoff testing. Classification. Examine a sample of canceled checks for the correct account classification. And this could be more significant with the checks, because obviously the checks going out, we want to make sure that they're classified correctly in terms of the cash account. We may, as we do this, consider where they're going to be classified elsewhere as well as part of our testing. So the cash going out may be for many different kind of sources. The cash coming in, we would expect not be from too many type of sources, mainly revenue we would expect. But the cash going out, we could be paying for a whole lot of different things. We want to make sure that, one, that the classification is correct with the proper cash account that the cash went out for. And two, we could check the other side of the transaction as well, as long as we're going through a sample of the cash checks. Was it properly classified in terms of the proper expense account and or other account that it was paid off for? Balance-related assertions. Now we're looking at the tests of details. Assertions are existence, completeness, accuracy, valuation, and allocation. So once again, these are the balance-related assertions, tests of details. First thing we're going to want is a bank confirmation to confirm the account balance. This is going to be something that will be standard. Doesn't really matter if we set the inherent risk or the control risk at high or low, we're still probably going to do, or pretty much always going to do, a bank confirmation. Now note, a bank confirmation is basically us asking the bank for what the balance is, to confirm the balance so that we can then tie that out and check that out to the balance that's being reported on the books. And we're going to have to do a bank reconciliation to do that. We'll discuss that in a bit more detail. However, you might think, hey, this is a bit of an overkill. Don't we have the bank statement? Because the bank statement is going to be something that's going to be, the company will have. It's being provided by the bank, and therefore it's a third-party documentation. So you would think that that would be pretty standard. So in other words, if we already have the bank statement from the bank, then why do we need another confirmation that's going to basically give us the same number that's the end number on the bank statement? And we want that because the bank statement was given to the company. We probably didn't get the bank statement sent directly to us as the auditor. So even though it's probably not the case that the company altered the bank statement, because cash is so liquid in such an important account, the fact that it's been touched by the hands of the company makes it less valuable of an evidence for our audit testing. We would like to get a direct confirmation from the bank. So our confirmation is going to go to the bank from us, the audit firm, to the bank. They're going to put the amount as of the date of that we're requesting, the year end 12/31 if it's 12/31, and send it directly back to us, never touching the hands of the company, and therefore it's going to be a higher value of evidence for us. Also note that it's possible that the bank statement isn't at the end of the month. So it's possible that the bank statements on the banks are something other than a month-end bank statement, and maybe it doesn't line up to the exact date. But even if it does, we're still going to do the bank confirmation. We're going to get the bank confirmation back. We're going to tie that in. Now, we're not going to be able to tie it into the books because we're going to have to do the bank reconciliation. Notice what's on the bank, what the bank says the company has in cash is not what they actually have if you account for the outstanding items, outstanding checks and deposits. In order to account for that, we'll have to do the bank reconciliation. Then we can match up what's on the bank to basically the bank reconciliation and reconcile to what is on the books and then have justification for that amount. So we're going to have to test the bank reconciliation for each account then. So for each account, we have to have a bank reconciliation for cash. The company should be doing bank reconciliations. If they're not, that's a pretty large deviation from internal controls over cash. So remember what the bank reconciliation does. It's going to take the balance on the books if it's a 12/31 account. So at the end of the year, 12/31, we want the bank reconciliation at least for that end time period so that we can check it as of the end of the year for that time period. And we're going to reconcile from what's on the books to what's on the bank statement. Why are they different? Because there's outstanding checks and outstanding deposits. Outstanding checks and deposits that we, the company, or the company knows about, have recorded, but which the bank don't know about yet because they haven't yet cleared. And then once we do the reconciliation from the bank to the books, accounting for these outstanding items, then we have assurance that the third-party number is accurate. Until we do the bank reconciliation, the bank balance isn't very important to us because it's not going to match the books, and therefore it's not going to be a big assertion for us or evidence, or not nowhere near as large as the evidence. If we can know exactly what that difference is, then we can take that balance and say, okay, this is evidence for us. So what are we going to do with the bank reconciliations? We're going to foot the reconciliations and the outstanding checks listed. So remember, bank reconciliation is going to have the book balance. It's going to have the activity that happens. It's going to have the outstanding checks, the outstanding deposits, and then the bank balance. So it's going to be reconciling the book balance and the bank balance. And so what we want to do then is go and add that up. Make sure that we're adding these items up, especially footing or adding up the list of outstanding items, outstanding checks. Trace balances per book to the general ledger. So we want to make sure, of course, that the amount that's on the bank statement for the book amount on the bank statement agrees to the amount on general ledger, which is going to be the amount that's going to be included in cash on the balance sheet. And then, as we do this, we're going to use our little auditing tick marks. We're going to put a little tick mark and say that this ties out to the amount on the on our books in the general ledger, and make sure that we have our little tick mark that basically ties that out as we go through. Obtain a standard bank confirmation and trace the balance per bank to the bank reconciliation. So this is where our confirmation comes into play. We got a confirmation that's different than the reconciliation. The reconciliation is the worksheet that we prepare, the company prepares internally. The confirmation is something that's coming that the auditor went directly to the bank to get the balance for. So we're going to take that confirmation and tie it out to basically our bank statement for the amount that's being recorded as the bank balance, which of course should also tie out to the bank statement. But the bank statement is not as reliable of the evidence as well. Obtain cutoff bank statement. So the cutoff bank statement is going to be a bank statement that will be basically after the year end. Remember that if we're auditing, say, 12/31 year end, that we're going to be auditing at least for half the month, after 12/31. What we want to do then is we have these outstanding items that we've reconciled for, and those outstanding checks and deposits are going to be things that we can then further check to see if they have cleared. And we do that by getting the cutoff bank statement for the next time period. So we're going to go to the bank and say, hey, could we have a bank statement for at least half the month for the next time period so we can check these outstanding items? And that'll help us to verify that the reconciling items, the outstanding checks, have indeed cleared in the next time period. Trace deposits in transit, outstanding checks, and other reconciling items to the cutoff bank statement. So again, we're going to take all the items that are outstanding outstanding checks and deposits, check to see if they've cleared in the following time period. That gives us confirmation that they're not made up amounts, that they are actual amounts, that the difference is really just simply a timing difference between when the bank is aware of them and when the company is aware of them. If control risk is high or a fraud is suspected, then we can do other types of testing. We can perform extended bank reconciliation procedures, perform a proof of cash, and test for kiting. So these are other kind of controls that we could put in place if the risk is high or a fraud is suspected. So what specifically do we need if we're going to be auditing, say, the general cash account? So if we're going to go in and audit the general cash account, what we're going to need as the auditor is a copy of the bank reconciliation, a bank statement for the cutoff period. So we want a bank statement for the cutoff period, and then we're going to want the standard bank confirmation. These are going to basically be the minimum requirements that we're going to need when we do the auditing of the account. Remember, the confirmation is going to be something that we, the auditor, sent to the company directly. They send a reply back to us, giving us what the ending bank balance will be. A bank reconciliation is what's done by the company internal document, reconciling what's on the bank statement at the end of the month, at the end of the time period, probably at 12/31, to what's on the books. That's the reconciliation process. And the bank statement for the cutoff period, or the cutoff bank statement, and that's going to be for the time period after the period has over, so we can check those outstanding items. Note, I would also include basically the bank statement for the period that is reconciled, because that's probably what's used by the organization in order to do the reconciliation process. So that would be useful as well. But when we tie out the bank balance, we want to tie it out to the bank confirmation, not simply just tie it out to the bank statement, because that's going to give us more valuable evidence. The cutoff bank statement will usually cover at least 7 to 10 days time period after the date the bank account is reconciled. So notice again, if we're doing a 12/31 year end, reconcile as a 12/31, there's going to be outstanding checks and deposits. We want then the cutoff bank statement so that we can check that those outstanding checks and deposits have indeed cleared in the cutoff time period. Outstanding items on the final bank reconciliation of the period should have cleared in the 7 to 10 day time period after that point, that we can then see that clearing process happening. Once they've cleared, that gives us the more evidence that they're not made up amounts, just a timing difference. So test of bank reconciliations. Procedures for the test of the bank reconciliation. We're going to verify mathematical accuracy. So we're going to add the thing up again. Match the balance per books to the general ledger. So whatever's on the bank reconciliation, obviously for the book balance, should match what's on the GL. So it should match what's basically going to be included in the cash account on the balance sheet. Agree the bank balance on the reconciliation with the balance on the bank confirmation. So obviously it's a reconciliation here between the books and the bank. So the bank balance and the bank reconciliation, we want to tie to not the bank statement, although we might do that too, just to have some further evidence, but definitely to the confirmation. The confirmation is more highly valued. So we're going to basically tie it out to the confirmation. Trace the deposits in transit on the bank reconciliation to the cutoff bank statement. So anything that's outstanding deposits, the reconciling items, outstanding checks, the reconciling items, we trace those to the next time period's cutoff bank statement, which we can get, because remember, we're not doing the audit as of exactly 12/31. It's probably going to take us like a full month, maybe even beyond that, to do the audit. So we may have time to have the full bank statement, after the time period has been over. But we at least want the cutoff bank statement, and we want to verify that the outstanding items have indeed cleared in the period after the one that we are checking. Next, we're going to match outstanding checks on the bank reconciliation with the canceled checks contained in the cutoff bank statement for the correct payee, amount, and endorsement. We will match any bank charges included on the bank statement to the bank reconciliation. Remember that the bank charges on the bank statement are probably going to be things that weren't included in the company books, because the company wouldn't know about them until they were on the bank statement. So that we would think that they're going to be something that would be included as we go through the process of the reconciliation process. Match the adjusted book balance to the cash account balance.